We want to talk the markets right now with Ross Mayfield, investment strategy analyst at Baird, which has $360 billion in assets under management. So let's dig through this, Ross. Did the world view change yesterday just based on those hotter PPI numbers, or is this kind of the Fed moving along, doing what it was intending to do, and the market just kind of maybe taking them more seriously at this point?
I think that's exactly right. I think the market is coming around to what the Fed has been saying for quite some time, which is they want to get to a terminal rate above 5% and keep it there at least for the entirety of 2023, if not into 2024, if inflation doesn't come down, to along the glide path they've set out. I don't think the market, is necessarily wrong to be skeptical of what the Fed is saying, because number one, they have to use their guidance as a tool. So they're going to be, they're going to jawbone hawkish, even if they don't necessarily mean it. And also, the market didn't, they were saying transitory a couple of years ago, and that proved incorrect. So I don't think the market was wrong to be a little skeptical, but they're certainly coming around to Chair Powell's view at this point.
Which means what? We've seen some big gains for the first 6 weeks of the year. Do we maintain that? Do we move ahead? Do you think we give those gains back as a result?
I think the gains to start the year are appropriately pricing the possibility of a softer landing. The labor market has remained really strong. Services economy really strong. Housing actually seems to have bottomed, with mortgage rates not needing to go back down to 3% to get some activity there. So I do think the market is better pricing a soft landing. We just think the upside from here, at least in the near or intermediate term, might be capped. It's hard to see valuations expanding much from here with rates at 5% or higher. And earnings are softening as rates and inflation weigh. So, we think the next leg higher might need a different catalyst. But the gains that we've made this year, I think, there might be some volatility, but are well earned.
So what do you tell investors to do at this point?
We're telling investors to stay the course, to be selective. I think our partners at Strategas, the Baird company, have called it a stock picker's market. Active outperformed last year, as much as it has in a long time. I think with rates higher and inflation higher, it's an opportunity to pick the right sectors, get in the right names that can survive and thrive in an environment like this. But mainly it's stay the course. The economy has proven stronger than pretty much anyone expected at this point, and we think there's light on the horizon.
So what are the right sectors? What are the right names?
I mean, right now, the cyclicals have been working. I think they're reflecting some of that economic momentum, things like industrials, things like materials, even things like consumer discretionary, as the consumer has proven strong. We got that retail sales number that was quite hot. But I wouldn't want to pull back entirely from some defensive positioning. I do think, again, in the near term, the risk might skew downside a little bit, and we would want to have some defensive positioning and still some fixed income in there, especially with yields doing what they're doing now.
What do you think about treasuries or bonds in general, corporate bonds?
Yeah, I think we want to be a little higher quality and a little bit shorter duration. So, at this point, credit spreads are still pretty tight, and the Fed still is hiking. We're probably heading for some sort of slowdown. Even if it's a mild recession, credit spreads will probably widen from here. So we like moving up in quality, moving up in duration a little bit. And treasuries are a good bet at this point.
Ross, thank you. Have a great weekend.
You do the same.